Welcome to the Season 3 finale of Nova Bourse US. I am your host, and today we are moving from theory into pure execution. We are wrapping up our deep dive into technical analysis by taking one stock, Nvidia, and applying every tool we have covered over the last 10 episodes to build a comprehensive professional-grade trading plan. We are talking about real numbers, specific entry points, and precise risk management. This is the moment where we stop studying the concepts and start building the blueprint for a trade. Let's get to work. We have spent the last 10 episodes mastering the building blocks of technical analysis, from price action and market structure to Fibonacci extensions, volume profiles, and the fusion of fundamental and technical data. Today, we close that chapter by applying everything we have learned to a single, concrete case study. We are not introducing new definitions here. Instead, we are looking at one stock at one specific moment in time to show you how to synthesize these tools into a cohesive plan. You will see how to determine your entry, your stop loss, your target, and your position size, all while checking your correlation risks. This is where theory finally meets the reality of the market. To build our plan, we start with the raw data for Nvidia as of early July 2026. The stock is trading near $211, with a massive market capitalization of $5.11 trillion. Its 52-week range stretches from $162.02 to $236.54. With a beta of 2.21, this stock is roughly twice as volatile as the S&P 500. We are seeing an average daily volume of 159 million shares and an average daily range of about 4.5%. These aren't just interesting facts. They are the constraints that dictate your stop-loss width and your total share count. When we look at volatility, we have to distinguish between the 14-day average true range, which sits near $5, and the average daily range percent. While $5 represents about 2.4% of the share price, the true daily volatility often pushes toward 4.5% during news events. Compare that to the 1.1% seen in Johnson & Johnson or the 2% in Apple. If you set a $2 stop on Nvidia, you're going to get stopped out by normal price noise. Your stop needs room to breathe, or you will be shaken out of a good trade simply because the stock is moving exactly as it should. We must also account for the 10-for-1 stock split from June 7, 2024. That event transformed a price of $1,208 into roughly $120. If you're looking at historical indicators or moving averages from before that date, you must divide those figures by 10 to maintain accuracy. Since the split, Nvidia has climbed to $210, a 75% gain. This split reset our psychological landscape. $100 is our new base, and $200 is the current barrier. Your plan has to respect how retail traders cluster their orders around these specific, split-adjusted round numbers. Earnings are a minefield for any trader. Since the AI boom began in late 2022, Nvidia has reported earnings 10 times, while the stock posted double-digit gains 4 times. Including the May 2024 split announcement, the trend has recently shifted. In 3 of the last 4 quarters leading up to May 2026, the stock finished the week lower, even after beating earnings estimates. Because the options market expects a move of 6.2%, the lesson is clear. Never hold a full position through an earnings announcement unless your risk model is designed to survive a 6% overnight gap. Looking at the monthly time frame through the lens of the Weinstein method, Nvidia is clearly in the Stage 2 advancing phase. The 30-week moving average, which acts as our 7.5-month line, is sloping upward at roughly $192. Price has remained above this line for 28 months straight, and relative strength against the S&P 500 is still positive. We see no signs of a Stage 3 top, as volume is not showing distribution, and the monthly RSI of 61 is not overbought by historical standards. The monthly trend is firmly our friend, so our strategy must be to align with this momentum, not fight it. Zooming into the weekly chart, the market structure confirms a sequence of higher highs and higher lows since October 2025. We saw a higher low at 188, a high at 212, another higher low at 191, and a high at 236. The most recent pullback held at 177, which is still above the previous higher low. The 50-day moving average on the daily chart, which appears as the 10-week line here, sits at $209. A drop below 192 would break our weekly structure and violate the 200-day moving average, marking our clear invalidation zone. The 200-day moving average on the daily chart is our macro benchmark, currently sitting at $191.67. This is the level institutions watch most closely. Since September 2024, every test of this average has held, including the April 7, 2026, intraday touch at $173.66. While the exact value of this moving average shifts slightly every day, its role as a support floor is fixed. If we see a sustained close below this average for 3 consecutive days, the macro picture shifts from bull to neutral, and that is your signal to exit. Below that 200-day moving average, we find a dense support cluster at $183. This level is critical for 3 reasons. First, it held as a swing low during the China export control panic in March 2025. Second, it served as the consolidation floor after the February earnings sell-off. Third, it aligns with the volume profile point of control from our September to December 2025 range. Because 3 independent technical methods converge at $183, a break here is not just a dip to buy, it is a fundamental breakdown of the stock's structural support. On the resistance side, we face a barrier at $212.66. This level has been tested twice, in November 2025 and January 2026, failing both times. Above that, the all-time intraday high of $236.54 represents our psychological ceiling. Finally, using the bars pattern technique on the October 2025 flag breakout, we project a measured move target of $245. These 3 levels, 212, 236, and 245, provide the hierarchy for our profit-taking strategy. We do not buy Nvidia because we like the company. We buy when 4 specific conditions align. First, the price must pull back within 2% of the 50-day moving average, which is currently $209. Second, the daily RSI must be between 40 and 55, indicating a reset. Third, volume on the pullback day must contract below the 20-day average, showing that selling pressure is drying up. Finally, the Nasdaq 100 must be above its own 20-day moving average, confirming the broader market is helping us. If even one of these conditions is missing, we stay on the sidelines. This is how we enforce discipline. For our first stop-loss method, we use the 200-day moving average as our structural invalidation point, with the average at $192. Placing a stop $3 lower at $188 gives us a $4 buffer against volatility. Since our entry is near $210, we are risking $22 per share. This is our widest stop, which is ideal if you want to hold through minor market noise. But remember that the wider risk means you must take a smaller position size. The benefit is that you are far less likely to be stopped out by a single bad headline. Method B is our balanced approach, using a volatility-adjusted stop. Since our 14-day average true range is $5, we place our stop 2 times that range below our entry. With an entry at $210, a $10 risk puts our stop at $200. This method scales with the stock's actual behavior rather than your personal comfort level. Because the risk per share is only $10, half of what we risked in Method A, you can afford to double your position size. This approach is backed by our previous testing on large-cap tech stocks with high betas, making it a very reliable standard. Method C is our tightest, most aggressive stop, anchored to the $183 support cluster. We place our stop at $179, which is $4 below that zone. This means we are accepting $29 of risk per share. This method is only for high-conviction trades where your position size is small enough to absorb a larger potential loss. The logic here is binary. If that triple support level breaks, the fundamental narrative for Nvidia has likely shifted due to issues like export controls or demand slowdowns. We want to be out of the trade entirely before any gap down accelerates. When it comes to taking profit, we use Method B's $10 risk to target a 2-to-1 reward ratio. Our first target is $230. This level is significant because it sits just below the January 2026 swing high, where profit-taking historically clusters. Once we hit 230, we sell half of our position and immediately move the stop on the remaining shares to our break-even price. This single disciplined act of taking partial profits at a 2-to-1 ratio is the primary difference between traders who stay in the game and those who eventually wash out. For our second target, we use a combination of Fibonacci extensions and bars pattern projections. The impulse wave from October to May measures $51. Applying a 127.2% Fibonacci extension from our April pullback low gives us a target near $242. Meanwhile, our bars pattern analysis from the October flag points to $245. By averaging these, we arrive at $243 as our extended target. For the remaining half of our position, we do not use a hard limit order. Instead, we trail our stop below the prior week's low, managing the trade actively as it develops. Let's look at the math for a $50,000 account using the 1% risk rule. We are risking $500 total on this trade. With an entry at 210 and a stop at 200, our risk per share is $10. 500 divided by 10 gives us a position size of 50 shares. This requires a capital deployment of $10,500 or 21% of our total account. If we hit our first target, the first 25 shares lock in $500 of profit, which covers our entire initial risk. The remaining 25 shares then effectively become a risk-free ride. We can also adjust our size based on volatility. If Nvidia's average true range expands to $8, our previous calculation no longer holds. Using the same $500 risk, we divide by 16, which is 2 times the new $8 range. That gives us 31 shares instead of 50. By using this ATR-adjusted method, we automatically reduce our exposure when the market gets erratic. We keep our dollar risk at $500, but we shrink our position to match the increased uncertainty. This is how you survive earnings season without having to guess. You let the volatility dictate your size. Finally, we must address the correlation trap. If you own Nvidia, AMD, Broadcom, and Taiwan Semiconductor, you are not diversified. You are simply making one big bet on the semiconductor industry. These stocks share a correlation coefficient as high as 0.85 during market stress. You must treat these as a single oversized position. If your total risk across all 4 names exceeds 6% of your account, you are over-concentrated. Your trading plan is not complete until you have checked your total portfolio heat to ensure you aren't accidentally doubling or tripling your risk on the same sector. Here is your complete plan card. We are entering Nvidia at $210 once our 4-condition checklist is met. We set our stop at $200 using the 2ATR method. We take half our profit at $230, and we manage the rest toward a $243 target. We are sizing at 50 shares for a $50,000 account, keeping our risk to 1%. We will check our portfolio heat to ensure total risk stays under 6%, and we will exit or reduce before the August 26th earnings report. We expect this setup to resolve over the next 2 to 8 weeks. As we wrap up, remember 3 core principles that apply to any stock. First, your stop distance must be derived from the stock's own volatility, not your personal risk tolerance. Second, support levels are only reliable when multiple independent methods converge. 1 method is a guess, but 3 is a plan. Third, position sizing is where the game is won. By choosing 50 shares instead of 200, we turned a potentially devastating 20% loss into a manageable 1% risk. These principles are universal. Whether you're trading Apple, Exxon, or any other ticker, use these rules to keep your capital safe and your edge sharp. You now have a complete technical trading plan. But remember that technical analysis does not exist in a vacuum. A strategy that works in a bull market can easily fall apart during a contraction. In Season 4, we are going to step back from the individual charts to look at the bigger picture. We will ask, what phase of the economic cycle are we in? Episode 29 will open our macro block by exploring the 4 phases of the economic cycle: expansion, peak, recession, and trough, along with the 6 major historical cycles every serious investor needs to understand. I will see you there.